If you ever caught yourself thinking, am I ready to raise capital? You're in good company. I hear that question constantly, and here's the surprise. It usually doesn't come from brand new founders. It comes from people who've been building for years, sometimes decades. They know their customers. They know their product. They know their team. They know how to create value.
And yet, they still feel unsure the moment the conversation shifts from running the business to raising money. That's the gap, right? They know business. They don't always know the capital raise process.
Exactly, because building a business and raising capital are different disciplines. Building is about products, customers, operations, hiring, and staying profitable. Raising is about translating that business into something a professional capital provider can evaluate.
When you say professional capital provider, we're talking about investors, lenders, private equity, family offices, and strategic buyers, right? People who are trained to look at opportunity, risk, return, and management capability.
That's it. And they're comparing you to dozens, sometimes hundreds of other opportunities. So the goal isn't to walk in and simply ask for money. The goal is to show up prepared in a way that makes it easy for the right partner to say yes.
Let's slow down there. A lot of owners think the capital raise begins when they start calling investors. But you're saying that's basically the end of the line, not the beginning.
For most companies, outreach is one of the last steps. The real work starts inside the business, long before the first meeting. Because the first question isn't, who should I pitch? It's, are we actually ready to be evaluated?
So what does readiness look like in practice? If someone listening is thinking, we're doing fine, revenue is up, customers are happy, what are the tough questions they should ask themselves?
I'd start with the basics that are not glamorous, but they decide everything. Are your financial statements accurate? And not just accurate. Are they understandable to an outside party? Could a lender or investor look at them and quickly grasp what's happening in the business?
Because the owner might understand every line item, but an investor doesn't have that context.
Right. Next, can you clearly explain how you make money? Not in a vague way, like, we sell great service. I mean, what drives revenue? What drives gross margin? What drives operating profit? And what drives cash? And by the way, those are not always the same story.
That cash point is huge. You can have a profitable business on paper and still be stressed every payroll.
Exactly. Investors and lenders care deeply about cash flow predictability. They'll ask, are margins healthy? Are they stable? What's causing them to move? Are cash flows dependable, or do they swing wildly? And if they swing, do you understand why?
And then there's growth. Everybody says they have growth potential. What does an investor want to see?
They want to see sustainable growth, not wishful thinking. They'll ask, what proof do you have that demand is real? Are there repeatable sales channels? Is churn under control? Can operations scale? And maybe most importantly, what's the plan? Not just, we'll hire more salespeople. A real plan with priorities, milestones, and economics behind it.
Let's talk about the part founders often avoid, risk. Because nobody wants to lead with, here's what could go wrong.
True, but the fastest way to lose credibility is pretending there are no risks. Every business has them. Customer concentration, supplier dependency, regulatory exposure, key person risk, margin pressure, technology disruption. The question is, do you know your risks and can you explain how you're managing them? Investors don't demand perfection. They demand awareness and control.
So the theme here is clarity. Clarity on the numbers, the model, the growth engine, the risks.
Yes, and clarity on the biggest question investors are asking silently. Why this business? Why does this deserve capital versus everything else they could do with that money? That's not arrogance. That's the job, to show why this is a compelling risk-adjusted opportunity.
You said something earlier that I want to underline. These aren't only investor questions. They're management questions.
They really are. And here's the irony. If you go through the discipline of preparing for a capital raise, the business often improves even if you never raise a dollar. You find reporting gaps. You discover margin leaks. You tighten working capital. You get more intentional about strategy. That's value creation with or without outside money.
Okay, but let's address the emotional reality. A lot of owners feel like capital is the solution. If we just had money, we could fix everything. And you're saying, not so fast.
Not so fast. One of the biggest misconceptions is that every business is automatically ready for outside capital. Many aren't. And in a lot of cases, the first financing you should pursue is internal. Pricing improvements, margin expansion, better collections, smarter inventory management, operational efficiency, maybe upgrading your management team.
So instead of adding capital, you're freeing capital.
That's a great way to put it. The cheapest capital you'll ever find is often already inside your business, trapped in inefficiencies or weak processes. Outside capital should amplify strength. It shouldn't be used to cover operational problems.
Let's say a company does the preparation and they are ready. What do people misunderstand about the actual capital raise process?
They underestimate how much of it is a process, not a single event. There's a sequence, and every step affects valuation, terms, timeline, and outcome.
Walk us through that sequence in plain language.
First, assess readiness. What will a capital provider see when they look under the hood? Second, decide what type of capital fits the business: debt, equity, a hybrid structure, maybe a strategic partner. Third, prepare the financial and operational information so it can survive scrutiny. Fourth, craft a narrative. Not hype narrative. The why, the how, and the where this goes next.
And that narrative is backed by materials, presentations, data, and a real set of numbers that connect.
Exactly. Then, identify the right targets. Not every investor is a match. Not every lender is a fit. Next, run due diligence. Be ready for investors to test everything. Then, negotiate terms. Price is one variable, but structure matters too. And finally, close. That last part sounds obvious, but deals fall apart late, when preparation was weak early.
So skipping prep isn't just risky, it's expensive. You might still raise money, but at a lower valuation, with tougher terms, or after losing months.
That's right. And in the worst case, you don't raise at all, and you've signaled to the market that something didn't work. Preparation protects you from that.
Let's talk about the best raises you've seen. What makes them different?
The best raises are not fueled by panic. They're fueled by preparation. Great companies raise capital before they absolutely need it. They can choose partners instead of begging for them.
And they know their story and their numbers.
Yes, they understand what they're great at. They're honest about what they're fixing, and they can clearly explain how new capital will produce measurable results. New locations, new capacity, acquisitions, product expansion, whatever the strategy is. Capital becomes a tool with a plan, not a lifeline.
I want to shift to what might be the most important reframing in this whole conversation. Most people ask, can I raise capital? But you're implying that's not the best question.
The better question is my business prepared to earn the confidence of the right capital partner? Because capital follows confidence.
And confidence isn't a vibe. It's built.
It's built through preparation. Clean reporting, clear unit economics, credible forecasting, thoughtful risk management, a strong team, and a strategy that makes sense. When those pieces are in place, the conversation changes. You stop selling. You start aligning.
Before we wrap, tell me where an investment banker or an advisor really fits. Because some owners think it's just introductions. Like, here's a list of investors.
Introductions are a small part of it. The real value is helping you see your business the way capital markets see it. Finding gaps you've learned to live with. Strengthening the story. Preparing you for diligence. Positioning the opportunity so the right partners can understand it quickly and trust it deeply.
So the capital raise might take a few months, but the outcome is decided much earlier.
Most of the time, yes. The preparation determines whether the outcome feels transformative or disappointing. For small and mid-sized businesses especially, capital readiness isn't a single moment. It's a discipline.
Let's leave listeners with something practical. If someone is listening right now and thinking, okay, what do I do this week? What's the first move?
Pick one of these and do it honestly. First, Have someone outside your day-to-day review your financials and tell you what's unclear. Second, write a one-page explanation of how your business makes money, revenue drivers, margin drivers, and cash drivers. Third, list your top 5 risks and what you're doing about each. If you can do those 3 things clearly, you're already ahead of where most companies start.
And if you can't do them yet, that's not failure. That's your roadmap.
Exactly, because the goal isn't to look perfect. The goal is to build the kind of confidence that attracts the right capital, on the right terms, at the right time,